$930 billion. That's how much commercial real estate debt comes due in 2026, not over the next decade, not spread across 5 years, in one single year. $930 billion of loans that borrowers took out during the era of zero interest rates. Loans that were supposed to be refinanced into a world that no longer exists. To put that in perspective, that's more than triple the $300 billion maturing in the second half of 2025. It's roughly the entire GDP of Switzerland, and it's landing on a market where office buildings sit empty, where property values have cratered, and where the banks holding these loans have been playing a dangerous game of pretend. The game is called extend and pretend, and time just ran out. By the end of this video, you're going to understand exactly what's happening in the commercial real estate market, why the biggest players on Wall Street are warning of hundreds of bank failures, and why the coming wave of defaults could trigger a financial crisis that makes 2008 look like a warm-up. This isn't speculation. The pattern has played out before, 3 times in the last 40 years. Same denial, same hidden losses, same inevitable collapse. And right now, we're watching it happen again in slow motion. Let me show you how we got here. Between 2020 and 2022, something unprecedented happened in commercial real estate. Interest rates were at zero. The Federal Reserve was printing $4 trillion, and money was looking for a home. Investors piled into commercial properties like never before. Office buildings, apartment complexes, shopping centers, hotels. Prices soared to all-time highs. Cap rates, which measure the yield on a property relative to its price, compressed to historic lows. Buildings that generated $1 million in annual income were selling for $25, $30, sometimes $40 million, and almost all of it was financed with debt. Here's how commercial real estate lending works. A property owner wants to buy a building. They put down 20 or 30% as equity and borrow the rest from a bank or a commercial mortgage-backed securities lender. The loan typically has a term of 5 to 10 years, with payments based on a 25 or 30-year amortization schedule. At the end of the term, there's a balloon payment. The borrower doesn't actually pay off the loan through monthly payments. They pay it off by refinancing into a new loan. The assumption baked into every commercial real estate transaction is that when the loan comes due, the owner will simply get a new loan at similar or better terms. That assumption just died. In 2022, the Federal Reserve started raising interest rates at the fastest pace in 40 years. The prime rate went from near zero to over 5%. Mortgage rates doubled. The cost of capital that had been essentially free for a decade suddenly became expensive, and that changed everything. A property that could support a loan at 3% interest cannot support the same loan at 7%. The math doesn't work. The debt service would consume all the income and then some. So when these loans come due, borrowers face an impossible choice. Either inject massive amounts of new equity to pay down the loan to a level that works at current rates, or hand the keys back to the lender. Most of them don't have the equity. Most of them are going to hand back the keys. But here's where it gets interesting. The keys haven't been handed back yet, not at scale, and there's a reason for that. The banks don't want the keys. Think about what happens when a bank forecloses on a commercial property. They have to mark the loan to its actual value. A loan they've been carrying at $100 million on their books might only be worth $60 million based on the current market. That $40 million loss has to be recognized. It hits their capital ratios, it triggers regulatory scrutiny, it raises questions about other loans in their portfolio. So instead of foreclosing, the banks have been doing something else. They've been extending the loans, modifying the terms, lowering the payments, pretending that the borrower will eventually be able to refinance when rates come down. This strategy has a name on Wall Street. They call it extend and pretend. And it's been working, sort of. The losses have been hidden. The day of reckoning has been postponed. From the outside, the banking system looks stable. But the debt doesn't disappear just because you don't look at it. Every extension pushes the maturity date further out. Every modification adds to the pile of loans that eventually have to be dealt with. The problem doesn't get smaller. It gets larger. And it all compounds into 2026. The Mortgage Bankers Association tracks commercial real estate loan maturities. Their data shows that loan volume maturing in 2026 is roughly 3 times the normal level. Why? Because all those extensions from 2023, 2024, and 2025 pushed the maturities forward. The banks bought time by creating a wall of debt that's about to hit all at once. $930 billion, the largest maturity wall in the history of commercial real estate. Now, I know what some of you are thinking. Maybe rates will come down, maybe the Fed will cut, and refinancing will become possible again. And that's true, the Fed has cut rates. About 150 basis points between late 2024 and mid-2025. But here's the problem. Rates aren't going back to zero. They're not going back to 2%. The Fed's own projections show rates stabilizing around 3 to 3.5%, and that's not low enough. A loan originated in 2021 at 3% needs rates below 4% to refinance without new equity. A loan originated with aggressive assumptions about rent growth and low cap rates needs rates even lower. The math doesn't work at current levels for a huge portion of this debt. And there's another problem that rate cuts can't solve. The buildings are empty. Office vacancy rates nationally have hit 19.4%. Nearly 1 in 5 office spaces in America is sitting empty. In some cities, it's worse. San Francisco is over 30%. Downtown Chicago, Los Angeles, Houston, all above 20%. This isn't a temporary COVID hangover. This is a structural shift. Remote work isn't going away. Hybrid schedules are the new normal. Companies that used to lease 50,000 square feet now lease 25,000. The demand for office space has permanently contracted. You can't refinance a building when there's no one to rent it. You can't service debt with income that doesn't exist. The vacancy crisis and the maturity wall are hitting at the same time, and the combination is lethal. Let me show you the pattern. The first time this exact situation played out was the savings and loan crisis of the 1980s. S&Ls had loaded up on commercial real estate loans during the boom of the early 80s. When rates spiked and property values crashed, the loans went bad. But the S&Ls didn't recognize the losses. They couldn't afford to. Recognizing losses would have made them insolvent, so they extended loans, restructured terms, and pretended the properties were still worth what they'd paid. Regulators played along. They allowed accounting tricks that masked the true condition of the balance sheets. They hoped the problem would work itself out. It didn't. By the time the crisis fully unwound, over 1,000 savings and loans had failed. The government created the Resolution Trust Corporation to liquidate the bad assets. The final cost to taxpayers was over $130 billion. In 1980s money, that was an astronomical sum. The pattern was clear. Hide the losses. Extend and pretend. Hope for a bailout. When the bailout becomes too expensive, the system collapses. Check. The second time was 2008. Commercial real estate wasn't the primary driver of that crisis. That honor goes to residential mortgage-backed securities. But commercial real estate played its part. During the boom, commercial property values soared on the same cheap money that inflated housing prices. When the crisis hit, commercial property values crashed by 40% or more. Loans went underwater. Borrowers defaulted. But here's what's relevant to today. The banks that were most exposed to commercial real estate were the regional banks, the community banks, the smaller institutions that don't have the diversification of a JP Morgan or a Bank of America. Hundreds of these banks failed between 2008 and 2012. The FDIC's problem bank list swelled to over 800 institutions. The Deposit Insurance Fund was nearly depleted, and it happened slowly. The failures didn't all come in 2008. They came in 2009, 2010, 2011, 2012. The extend and pretend strategy delayed the reckoning, but it didn't prevent it. The losses were real. They just took years to fully emerge. Check. The third example is Japan, and this one is the most instructive because it shows what happens when extend and pretend becomes permanent policy. In 1991, Japan's commercial real estate bubble burst. Property values that had reached absurd heights crashed by 60, 70, 80% in some areas. The loans backing these properties were worthless, but the Japanese banks didn't recognize the losses. The regulators didn't force them to. Instead, they extended the loans, restructured the terms, and kept the zombie properties on their books at fictitious values. They called these zombie loans, loans that should have been dead but were kept alive through artificial means. And the zombie loans created zombie companies, businesses that should have failed but were kept alive by banks that couldn't afford to cut them off because doing so would force recognition of losses. The result was 2 lost decades. Japan's economy stagnated for over 20 years. Growth flatlined, innovation stalled. An entire generation came of age in an economy that couldn't escape the weight of losses that were never properly recognized. That's the end game of extend and pretend, not a dramatic crash. Something worse. A slow, grinding decline that never ends because the problems are never resolved. Check. 3 examples. Same pattern, same denial, same attempt to delay the inevitable, same outcome. Now let me tell you exactly where we are in 2026. Commercial real estate loan delinquencies are already rising. The overall delinquency rate hit 1.57% in the second quarter of 2025, the highest in a decade. That might not sound like much, but remember, the banks have been extending loans to keep them current. The true distress level is much higher than the delinquency numbers suggest. The commercial mortgage-backed securities market tells a different story. CMBS loans don't get the same extend and pretend treatment because they're held by investors who demand payment. CMBS delinquency rates have hit 7.29%. That's nearly 6 times the bank loan delinquency rate. 7.29%. That means roughly 1 in 14 commercial mortgage-backed securities loans is not being paid as agreed, and that number is climbing. The special servicing rate, which measures loans that have been transferred to special servicers due to distress, is even higher. In the office sector, special servicing rates have exceeded 10%. 1 in 10 office loans is in some form of workout or distress. And the foreclosures have started. In the first half of 2025, lenders recorded nearly 150 commercial real estate foreclosures. That's the highest mid-year total since 2014. And 2/3 of the apartment foreclosures involved loans from 2021 or 2022, exactly the vintage we've been talking about. Jim Costello from MSCI, one of the most respected commercial real estate analytics firms, says 60% of those troubled apartment loans mature in the second half of 2026. He expects a fresh wave of foreclosures when they come due. His description of the current environment is telling. He said the last crisis, 2008, was more of a rip the Band-Aid off approach. Lenders took their losses quickly. This one, he said, is slower, pulling the Band-Aid off slowly. The losses are the same. They're just being revealed gradually instead of all at once. And that gradual revelation is about to accelerate. Here's the insider evidence that we're in stage 3, the silent repositioning. Barry Sternlicht runs Starwood Capital Group, one of the largest commercial real estate investment firms in the world. In May 2024, he predicted that a regional bank would fail every day or every week. Days later, Howard Lutnick, the chairman of Newmark, one of the largest commercial real estate services firms, went further. He said, and I quote, "Every single weekend a regional bank is going to go bye-bye." He predicted 500 to 1,000 bank failures in 2025 and 2026, 500 to 1,000 banks. These aren't conspiracy theorists on the internet. These are the biggest players in commercial real estate, the people who see the actual loan files, the people who know which buildings are empty and which borrowers can't pay. PIMCO's head of global private commercial real estate joined the chorus in June. Their assessment was the same. Commercial real estate distress, particularly in office, is going to collapse small and mid-sized banks. The Office of Financial Research, a federal agency created after 2008 to monitor systemic risk, published a report identifying 54 banks with dangerous combinations of commercial real estate concentration and uninsured deposit ratios. These are the banks most vulnerable to a run, most vulnerable to failure, and the banks know it too. Look at what they're doing, not what they're saying. Commercial real estate lending by banks surged 85% year over year through the third quarter of 2025. Why would banks increase lending into a troubled market? Because they're trying to refinance their own problem loans. They're rolling the bad debt forward, buying more time, praying that something changes. Meanwhile, the big banks with diversified portfolios are quietly reducing their commercial real estate exposure. JP Morgan, Bank of America, Wells Fargo, they're all pulling back from new commercial real estate lending while extending their existing troubled loans. The insiders are positioning, the smart money is getting out, and they're not advertising it. Now let me address the hopeful narrative. You've probably seen headlines saying commercial real estate is stabilizing, transaction volume is up. The crisis didn't happen. We're through the worst of it. Here's what those headlines don't tell you. Transaction volume is up because distressed assets are starting to trade. Properties that were held off the market for 3 years are finally being sold, but they're being sold at massive discounts, 20, 30, 40% below their peak values. Every transaction crystallizes a loss that was previously hidden. The stabilization narrative is also heavily skewed by sector. Multifamily and industrial are doing relatively well. Data centers are booming. But office, which represents the single largest category of commercial real estate debt, is in freefall. The national office vacancy rate has not peaked. It's still rising. Companies are still downsizing. Leases signed in 2019 and 2020 are expiring and not being renewed. The structural demand destruction continues. And the regional banks that are most exposed to commercial real estate are not out of the woods. New York Community Bancorp, one of the largest commercial real estate lenders, reported a $2.7 billion loss in late 2023, leading to a credit downgrade and emergency recapitalization. Flagstar Financial saw its shares collapse after slashing its dividend and announcing massive unexpected credit losses tied to office loans. These aren't isolated incidents. They're early warnings, the first cracks in a dam that's holding back $930 billion of maturing debt. Let me tell you what stage 4 looks like when it arrives. The maturity wall hits. $930 billion of loans come due over the course of 2026. Borrowers who've been waiting for rate cuts realize that rates aren't going low enough. Borrowers who've been hoping for a recovery in property values realize the recovery isn't coming. They approach their banks for modifications, but the banks have run out of room. They've already extended these loans once, twice, 3 times. Regulators are asking questions. Auditors are demanding realistic valuations. The extend and pretend game is over. The banks have to choose. Extend again and risk regulatory action, or foreclose and recognize the losses. Some choose to extend. Their balance sheets become increasingly fictional. Their capital ratios paper thin. They become zombie banks, unable to make new loans because all their capital is tied up in bad commercial real estate. Others choose to foreclose. The properties hit the market. But there are no buyers at current prices. Not enough, anyway. The properties trade at 50, 60, 70 cents on the dollar. Each sale sets a new comparable value that forces other banks to write down similar properties. The write-downs cascade through the regional banking system. Banks that were marginally capitalized become undercapitalized. Undercapitalized banks become insolvent. The FDIC steps in for Friday night takeovers, selling failed banks to stronger institutions or liquidating them entirely. But unlike 2008, the stronger institutions aren't that strong. Everyone has commercial real estate exposure. Everyone has losses they haven't recognized. The buyers for failed banks don't materialize. The FDIC's Deposit Insurance Fund, which had about $130 billion at the end of 2024, starts depleting rapidly. Each failure costs billions. The fund that's supposed to protect depositors gets drawn down to dangerous levels. Depositors notice. Uninsured depositors, those with more than $250,000, start moving money to the biggest banks. JP Morgan, Bank of America, the too big to fail institutions. The flight to safety accelerates the regional bank crisis. Credit markets tighten. Banks that are worried about their own survival stop lending. Commercial real estate borrowers who might have survived with a new loan can't get financing. Businesses that relied on regional bank credit lines find those lines frozen. The commercial real estate crisis becomes a credit crisis. The credit crisis becomes an economic crisis. Unemployment rises, consumer spending falls. The recession that everyone kept predicting but never arrived finally shows up. And through it all, the Federal Reserve faces an impossible choice. They can let the regional banks fail, hundreds of them, maybe the 500 to 1,000 that Howard Lutnick predicted. The FDIC can try to manage an orderly resolution, but there's nothing orderly about 1,000 bank failures. The economic damage would be severe, the political fallout catastrophic. Or they can intervene, provide emergency lending facilities, expand the discount window, maybe even restart quantitative easing to support commercial real estate prices. Bail out the banks that made bad loans with taxpayer money or printed money, which amounts to the same thing. If they choose intervention, the immediate crisis passes, but the moral hazard gets worse. The losses get socialized. The zombie banks and zombie properties survive to drag down the economy for another decade. There is no good outcome. There's only a choice between different flavors of bad. So what do you do with this information? First, know your exposure. If you have deposits at a regional bank, check their commercial real estate concentration. The data is publicly available in their call reports. Any bank with commercial real estate loans exceeding 300% of their equity capital is at elevated risk. Move deposits above the FDIC insurance limit to a larger institution. Second, understand the second-order effects. Commercial real estate distress doesn't stay contained. It spreads to commercial mortgage-backed securities held by bond funds, REITs that own commercial properties, banks that service commercial real estate, and companies that rely on commercial real estate for their business. Check your investment portfolio. Check your retirement accounts. See what commercial real estate exposure is hiding in your mutual funds and ETFs. You might be surprised. Third, watch the regional banks. The first failures will be canaries in the coal mine. When you see FDIC takeovers of commercial real estate heavy banks accelerating, when you see the Deposit Insurance Fund drawing down, when you see emergency lending facilities being activated, those are the signals that Stage 4 has begun. Fourth, don't assume the crisis will be quick. The Japanese experience shows that extend and pretend can drag on for decades. The losses are real, but the recognition of those losses can be stretched over years. This might not be a dramatic crash. It might be a slow grinding weight on the economy that suppresses growth for a generation. Fifth, think about what you own versus what you're owed. Bank deposits are a promise to pay. So are bonds. So is commercial paper. In a crisis, promises can be broken or inflated away. Real assets, things you actually own and control, maintain their value even when the financial system strains. The maturity wall is coming. $930 billion in 2026. The banks have been hiding the losses, but they can't hide them forever. The foreclosures have already started. The insider warnings have already been issued. The Stage 3 repositioning is underway. 500 to 1,000 bank failures. That's not my prediction. That's Howard Lutnick, the chairman of one of the largest commercial real estate firms in the world. That's Barry Sternlicht, who manages $60 billion in real estate assets. They see the loan files. They know what's coming. The pattern is clear. S&L Crisis, 2008, Japan. Same denial, same extend and pretend, same eventual reckoning. The only question is whether the reckoning is fast and dramatic or slow and grinding, a crisis or a lost decade. Both are bad. Neither is avoidable at this point. The losses are real. They exist. They're sitting on bank balance sheets disguised as performing loans. They're hiding in commercial mortgage-backed securities rated investment grade. They're embedded in pension funds and retirement accounts that own commercial real estate debt. The only question is when those losses get recognized and who pays for them. In part 2, we're going to examine exactly which banks are most at risk, how to identify them using publicly available data, and what the FDIC's game plan looks like when the failures accelerate. You're going to want to see that. Make sure you're subscribed. Share this with anyone who has money in a regional bank or commercial real estate exposure in their portfolio. The insiders are preparing, the smart money is repositioning. Now you know what they know. The wall is coming.